manipulations end badly. You can only suppress the price or manipulate a market for a long extended period of time by pushing it in the direction that it is going. And if it starts to move the other way and you're still trying to cling to the same program that you've done in the past, that's when things get very dangerous. And that's where we are right now.
This is Kaiser Johnson with Liberty and Finance. Right now you can swap any uncirculated 1-ounce gold coin or 1-ounce carded bar for an MS62 $20 Liberty with no extra premium whatsoever. Just ship us your gold coins or bars and exchange them for an MS62 numismatic Liberty at no extra cost. Call us for details.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us every week for this weekly market update. Today is Tuesday, September 2nd, 2025. Andy, thanks for coming back on Liberty and Finance.
Good to be here, Dunnigan. Thanks for having me again, my man.
Absolutely wouldn't miss it if I didn't have to. I thought I was not going to make it because I was down over the weekend with a severe cold. Who knows what it is, cold, flu, COVID, but I have had an amazing rebound, thank God, and thank my wife for a lot of ideas and my daughter-in-law for some ideas of natural remedies, and here I am.
Glad you're better.
Yeah, thank you. Wanted to get your read on something that appears to be blowing up the metals markets, perhaps one of many currents in this stream of many currents that's making an effect for the breakout of both silver and gold, and that is the terrible performance of the UK bond market and the Japanese bond market. They are in great distress. The charts look terrible this morning. I wonder if you could bring us up to date on that. Meanwhile, I'll try to share a screenshot from the Kobayashi letter that discusses this topic that was brought up by one of the brokers at Miles Franklin, but I'll go ahead and unleash you on it while I'm trying to share here. Go ahead.
Yeah, I mean, I haven't had a chance to see the article, but I think that it's fairly easy, I think, to discern what exactly is happening is that all of these Western countries are massively indebted, and trying to suppress interest rates on the short end of the bond market is basically signaling to the world that this is a problem that they're trapped under, and that the long end of the curve is not controlled by the central bank. The long end of the curve is the 10 or the 30 year would be all about the bond market itself, who it's basically saying that, yes, there will always be demand for these treasuries, whether they be in the United Kingdom or in Japan or in the United States, but at what rate? And the bond market, I think when at least here in the United States, when we try and talk about rate cuts and pushing down the front end of the curve, I think you'll see something similar. We saw it already. What happened several months ago when they tried to lower the short end by 100 basis points, the 10-year went up almost exactly the same amount. That's what we're seeing. We're at the end game where there's so much debt out there that rates have to go higher to compensate for not only the poor performance of the currencies, the underlying currencies, but also for the interest rates that we're getting paid on the yield on the treasuries that you're buying due to inflation and devaluation, if you will, of globally of the value of the currencies that it's valued or that they're valued in. So I don't know if I made that very clear, other than to simply say the bond market is more powerful than the central planners. And especially at this late stage game where it's become very obvious that these countries want to inflate their way or print their way out of the problem. And the bond market is saying, you're going to have to pay a much higher rate of return in order for us to accept your bonds.
Yeah, so there's several principles. One you just enunciated there was that the bond market is stronger than the central planners. The other that our mutual acquaintance Gregor Mannarino talks about and has talked about for years is that the tell that he's looking for in the markets is that the bond market is much, much larger and more powerful than the stock markets, that all of the attention of the nightly news, they've got it always, the ticker running is the Dow Jones or this S&P 500. It's always the stock market they're focusing on. He says, people, you're looking at a derivative of you're looking at out the side view or the rear view mirror rather than what's coming. The bond market will be the thing that tells you what's coming. And what he's going to look for, he says, is for an uncontrolled spike in long-term interest rates that says the market has had it with the risk, and they're not willing to take on the risk, just as you outlined.
That's what it all is. That's what it all is. I mean, who in their right mind would hold any duration at all of a treasury in an environment where they have no choice but to print and to weaken the dollar? I think that's really the crux of it all. And that, when you talk about what higher rates would do, higher rates would actually be the cure for a lot of these problems, as it would make assets more affordable for people, as we would see real valuations. We'd see real price discovery. And, aside from the fact that we have no choice, rather, but to continue to inflate, we're going to reaccelerate the inflation engine by cutting rates. And that's the thing, is that these people, the bond market understands that when we bring it home and look at the United States, rising inflation into a weakening labor market where we've seen 461,000 jobs revised. At the same time, they're talking about upwards of 500,000 job revision here leading up to the September rate cut meeting. That's what they're expecting. And this is in an environment where, and I'm sure it's similar around the world, the CPI has stayed above 2% for 53 straight months. The PPI, the producer price inflation measure, is at a 3-year high. So I think all of these countries basically, or all these bond markets basically, realize that cuts would be a short-term debt relief tool, but at the cost of massive money printing and more inflation. So for the long end, we need much higher rates in order to justify it. I would expect to see the same thing in the U.S. bond market, if not for overt quantitative easing, in essence, where the government comes in and acts as the buyer of last resort. Because who in their right mind would buy a treasury yielding 4% on a 30-year when the dollar's already down 11% this year and inflation is running much higher than that? Just ask John Williams, not the 3% or just under that we're being told, but he'd say add 8 to those numbers. You're at 11% inflation if you're being honest. Rates have to go much higher to attract that demand.
And at the same time, we're seeing what you would have predicted, and you have been predicting for some time, and that is that gold and silver, as well as other commodities, are going to tell the truth about the destruction of the purchasing power of the currency and the risk, that posture that anyone who's a holder of long-term bonds is going to be feeling, because as the rates spike uncontrollably on long-term bonds due to the risk appetite that you're talking about, that's going to drive down the value of bond portfolios held by banks, by retirement funds, by pensions, by all kinds of things. So you're seeing a breakout in the precious metals, and that's your wheelhouse. Can you tell us what you're seeing there and what you've seen before in conditions like these?
Well, I mean, look, right now, gold is at an all-time high of 24% of global reserves as of Q1 this year. It's the highest in 30 years anyway. And whereas the U.S. dollar share fell to 42%, that's the lowest since, I don't know, at least 1990. And so, we've seen so far in September, the September deliveries, 267,200 ounces or 8.3 tons have been delivered into COMEX. Over 42 million ounces of silver, 1.3 tons, which is a massive amount in a non-delivery month. One of the things that I find to be particularly disgusting, Ed Steer talks a lot about it, is the short position on SLV at a 14-year high of 54 million ounces short. And it's funny because BlackRock previously warned of shortages in that there could come a time when there's not enough silver to cover these short positions. They warned about it, and they talked about it in the ETFs. We also see right now exchange for physical on silver spread of $1.14. This is extraordinarily high. Normally, it's just a matter of 15, 20 cents or less. At $1.14, this signals either physical shortages or financial stress in the markets in London, where they can exchange for physical a COMEX contract into London. At $1.14, that's way, way, way up from what it should be, and this is not a good thing. At the same time, we see silver really and gold breaking out of a multi-month consolidation where it's been trading at a sideways pattern and shot up recently, of course, over the weekend or into the weekend at futures at $42 right now. In fact, let me just take a look and see what the futures are. Right now, the silver futures are 41.59, so come back a little bit, still up 87 cents. And so, we're beginning to see accumulation by the big money quietly start to translate into higher prices at a time when the public is still completely and totally asleep at the switch. Same thing we're seeing in platinum. That's kind of been quiet, but it's interesting because platinum and silver, which have both done very well, have now been reclassified as critical minerals by the government. And so it's almost like it's the Treasury preparing to stockpile again. We've talked a lot about platinum or silver and the shortage, but the Japanese guy who's the head of the TOCOM exchange has come out and said there's no platinum available in London or Switzerland, yet they're trading 3 million ounces of spot contracts deliverable per day. Well, that's also been classified as critical. So I would expect hoarding of both platinum and silver. I think what the U.S. is realizing that these are national priorities. We've talked about that. Someone got into his ear and said, this is what the BRICS are doing. We better do the same thing. And then you look at the way that some countries are reacting right now. As right at the same time U.S. declares silver as a national priority, you have Saudi Arabia buy a bunch in SLV. You see India's demand of silver is up 431% year over year in May, and record ETF inflows in June despite higher prices. So there's a lot of demand for physical metal that hasn't translated into the retail side of it yet. But the rest of the world, the big money, whether it be on the exchanges or the central banks or the sovereign wealth funds, are making it very clear that silver and gold are quite significant, and platinum, to their plans moving forward.
Make a point to remind everyone here who may not have been catching our previous episodes that you've been pointing out to us for at least 2 years that silver is a strategic metal. It's a defense critical material, and it's been absolutely silent on that front, other than the Silver Institute saying, hey guys, you're in a structural deficit. Hey guys, you're in a structural deficit year after year. Do you want to circle back on that? Because now it's being admitted. It's been officially added to the very top of the critical materials list that the U.S. has to prioritize.
Yeah, I think they didn't. When you see 8 Western banks, and I'll talk about Ed Steer's chart again that you showed several months ago, when you see 8 Western banks that maintain the largest concentrated position of any commodity ever traded on COMEX, it's not to hold down the price. Well, it is, but it's not price that's bothering them because silver is inelastic. You don't need a lot to make a very expensive item. Even if it's 500 ounces in a Tomahawk cruise missile that costs millions and millions of dollars, or a fifth of or a sixth or eighth of an ounce in an iPhone, the cost of the finished product is so much higher than the little incremental price of silver. It doesn't matter. More along the lines of they've tried to step on it because rising price would attract demand, and there's not enough availability of it. The price has been skewed by the trading on COMEX and the LBMA. It's real value skewed, and so I think the rising price would attract investors, speculators. They don't want that. It's more along the lines of being able to access stockpiles of silver rather than the cost of the silver. I know that sounds kind of strange, but if you're making it for all of these critical components, it's less about the price and more about the availability because it's used in such small amounts in whatever the finished product is. But you're right. It has been suppressed. It has been held down. It has been manipulated. And I think now there's a race to accumulate it because indeed it is strategic. It is critical. It is needed not just in electronics and electrical components, just about anything that conducts electricity. It is needed in military components. It is needed in medical devices. It is needed in so many places, solar panels, etc. And that plurality of demand, from monetary demand to military demand to industrial demand, makes it strategic, every bit as strategic as any of these other strategic metals. And I think that's the change, is that Trump understands it, his administration understands it. So, this is something I think that will continue, and there will be at some point, I see a battle between the industrials and the, or shall I say, the manufacturers, the producers who need it, and the investors. So you're going to get companies like Tesla and Panasonic and Sony and whatnot in a battle for what's available. As the hedge funds and the investors start to take the other side, they're going to battle, and it's about availability of a depleting asset. It's not as much about the price, but just about the availability. And you start to wake everyone up just like that. It disappears. And what is a shortage on COMEX spills into a shortage globally across the board into retail as well. Not there yet. There's still great values, but I see that happening as where this ultimately goes to.
In the past, we've seen some blow-ups in markets similar to that. For example, nickel a couple of years ago on the COMEX. What have you seen happen in the past when suddenly it's like everybody gets the same awareness at the same time that there aren't enough chairs in the game of musical chairs?
But when you have such large short positions, that can be a very big problem. You get short squeezes, then you really get prices moving in a vertical parabolic fashion. Nickel's a good example, except they basically reversed all the transactions. And as far as I'm concerned, LBMA lost all credibility when they did that. But that's what happens when you mess with Mother Nature and you suppress all of these things for, ill intent. The markets need to operate freely. Free markets seem to find equilibrium where they should be. When you suppress the freedom in free markets and allow these distortions to happen, that's why all manipulations end badly. You can only suppress a price or manipulate a market for a long extended period of time by pushing it in the direction that it is going. And if it starts to move the other way and you're still trying to cling to the same program that you've done in the past, that's when things get very dangerous. And that's where we are right now. I would argue that will end badly, and you'll see prices go much higher. You'll see whether it be hedge funds or commercial banks go under as a result of their stupidity to short all of these. It's an existential threat. One could argue this is what put Bear Stearns out of business. So to me, you just play the long game, and it's been a long, arduous journey to where we are now. But if I would have told people, a year ago that we'll be staring at $42, in early, mid-2025, I think most people would have been happy about that. Quite frankly, I think it's just beginning. We're a long ways away from seeing where this ultimately stops, but this is where it should have been a long time ago, and I think it's still got a lot of room to run based upon everything that I'm seeing, whether it be anecdotally or economically, or just by the movements of the biggest players in the world with Russia and India and Saudi Arabia and China. They're all gobbling up silver as fast as they can. Evidently, so are the folks in the United States now, too, at least on the COMEX. When that translates to the retail side, which I believe it will, something will wake up the public, that's when we'll see real fireworks. And of course, we're not there yet, but that's a benefit to all of you who are trying to add to your portfolio before the prices get out of hand.
You've been through this rodeo before. You and your dad founded Miles Franklin Precious Metals back in 1990. That's a long time ago, and you've been through at least a couple major bull market cycles. What have you observed is the progression as you're describing it, or is there a difference every time? So every time is a new phenomenon in terms of the sequence of things you're seeing on the supply imbalances that show themselves before you get these major moves in price.
Well, I think a real bull market is one that continues to move up gradually, kind of like what we're seeing here. I would argue the difference right now between this market and ones in past is the corrections. The corrections are nowhere near what they were before, where you would see a correction and the price would get stepped on and go lower and lower and lower, wouldn't come back, like in 2011. The corrections that we are seeing now are very shallow. While they can be steep, they don't last very long, and the price comes right back. That is an underlying reality of physical demand at the highest levels. What's unusual about this one is the price. If you would have told me gold would be at $3,500, and most people wouldn't know a gold eagle if it fell on their foot, is shocking to me, which tells me we're very early yet in this bull market. But a price that continues to move higher without gaining any attention, to me, is very bullish, because it's the biggest money in the world that is pushing it higher as the public is moving it completely and totally lockstep in the other direction. It's, to me, very, very bullish and a contrarian indicator that this is indeed happening.
When we describe saying, gold's at an all-time high, that sort of thing, we're talking about inflated dollars. Out of one side of our mouth, we put our arms, link arms with John Williams from shadowstats.com and go, this is ridiculous. You can't measure things in these inflated funny money, monopoly money dollars. They're destroying the currency. No wonder gold and silver are telling the truth about it. But on the other hand, we say, this is the most expensive it's been. And in fact, in the 55 plus community where we live, when it sometimes comes up in conversation, people say, oh, gee, I wouldn't touch gold right now because it's at all-time highs. And so where do you put that kind of thinking when you adjust it in gold being the baseline? Gold is actually the measure, not the dollar, where we're at in this cycle.
Uninformed and hypocritical, because these are the same people that are all in equities at all-time highs, at the highest valuation since the 1929 crash, held up by 7 stocks, where the rest of the stocks in total are barely up at all on the Russell 2000. It's just naive as far as I'm concerned. And it's the fact that people don't understand that, yes, gold is at all-time highs or damn well near it, but because of overt suppression to make the dollar and the bond market look better than it is, or they are, no one knows how high gold and silver should be. But this is exactly the sentiment you would want if you're already positioned, because this is why so few investors ever make money. They miss the important part of the equation. The fundamentals, they don't understand, and they just look at price, which is the ultimate tool of misdirection. That's why they do it. The big money knows that they can mess with the price and everyone else just keeps on walking. The people who understand value, understand math, understand logic, they take the time to apply it to this thesis, to this idea, would walk away saying, yeah, that's exactly why the big money is accumulating it quietly. This is the don't do as I say, do as I do. I would say that those people who are making that assessment are making a very foolish and ill-informed, hasty appraisal of the situation.
I know we've talked about this before, but I want to loop back on it again. This is the ordinary moms and pops we're talking about at the moment, but there are a significant layer of money managers above that layer of retail investors who are shepherding the endowments, the retirement plans, the pension plans, the insurance funds to underwrite, to backstop, supposedly, millions of people's nest eggs and retirements. What's your view of the awareness at that level, evidenced by what's been going on in terms of investment demand in the face of this accumulation by the largest players in the world?
They don't have any idea either. I mean, the market continues to move higher, and it's without any regard for risk, or a risk of prevention or aversion. So I think that the pensions are in very big trouble. I mean, where do they get their yield? They're forced into the equity market because they're not getting it in the bond market. They're forced into the equity markets at all-time highs, at all-time valuations. And I think this in and of itself is scary because, I believe that there, especially if we see a decrease in yield or rates, you got valuations at literally 1929 style extremes. You got all of the insiders, the veterans, Gartham and Buffett and Dalio. They're all talking of highlighting systemic risk. You have insiders selling, as we've talked about, the industrials, or the institutionals rather, Bezos and Zuckerberg unloading billions in stock. And I just think that this is a very, very dangerous time where the insiders are moving out, but the hedge fund or the pension funds don't have much choice but to speculate. They're not getting the return that they had thought they would with treasuries or had hoped for, so they have to, at that point, speculate into the equity markets as some of the most informed money in the world is moving in the other direction. And buying gold, which doesn't pay a coupon, even though it's outperformed everything, they won't even look at it. They won't even think about it. So it's putting a lot of people and their future in trouble, in jeopardy. I look for the pensions and to have before it's all said and done, the pensions will be something that you hear a lot more about, just simply because they are forced to take chances in order to get the returns that people are counting on. So yeah, they're not involved in this at all. They're not involved in any commodities because they don't pay a yield. They don't pay a return. So that's off the table as far as I'm concerned.
Yep, that whole topic of pension risk transfer from private pension plans and companies that maintain them into large hands of insurance companies that are saying, "Don't worry, we'll backstop you." Because we've got deep pockets and we've got these portfolios of whatever. Those portfolios, as you've described, and Alistair McLeod has,
loaded with treasuries
and big packaged mortgage bundles, whether it's commercial mortgages or whether it's residential mortgages, all of which are looking horribly toxic going forward. So concerning times at that level of the financial management cake. You watch several other factors that are going on in the news. Is there anything major that's on your radar this week that we haven't talked about that you should wanted to add for the weekly market update?
A lot of gold and silver coming into the market, into COMEX. So far for September, 267,000 ounces delivered, 42 million ounces of silver delivered, which is huge. We talked about the shorts are up big time in SLV, which is huge. We talked about the BRICS meeting, the Shanghai Cooperation meeting. I think what I take away from that is that Trump overplayed his card with India, threatening 50% tariffs. When you look at the actual numbers, even though we are their largest trading partner, arguably, it only accounts for under 3% of their GDP, their trade with us. You look at a country like Mexico or Canada, where it's the majority, that's different. We'll have greater weight. The purchase of Russian oil for India is far, far more important to them. And this is why you see Xi and Modi and Putin shake hands and smile and hug at the Shanghai Cooperation meeting. The SCO is no small organization. I've talked a lot about it on your show. It's over 40% of global population, 35% of global GDP, 24% of the land area. And so when you talk about takeaways, I think the fact that Modi stresses strategic autonomy, will not trade long-term interests for short-term appeasement. And, they're making stronger ties with Russia, with energy and defense and security. One of the things that I found interesting was that China is now embarking upon mandatory AI education from primary school, building all the way up through high school to build a AI talent pipeline. And so I found that to be very interesting. I also found it interesting that of all of the Gen Zs polled, that the number one job that came out on top wanting to be was a social influencer. And yet you have all of these kids in China that are becoming engineers and astronauts and becoming proficient in AI from elementary school on. These are the things we're getting left behind, whether it be in the way that our kids are being raised with education or what's happening in our U.S. foreign policy missteps under the Trump administration. As much as I would vote for him again, I think he really overplayed his hand with a country like India. And I think that these are the kind of mistakes that are going to have ramifications with the continuing emergence and strengthening of not only the Shanghai Cooperation Organization, but the BRICS. We have not heard the end of that yet, but I found it interesting that more or less Modi came out and said, we're not going to back down from our relationship with Russia and or our oil purchases from them. It's more important than just about anything right now. So how this all plays out, I guess we'll see. But putting 50% tariffs on India was, I think, a big misstep. And that's what I took out of the Shanghai Cooperation Organization meeting. Other than that, like I said, likely to see payrolls be revised. I've read from anywhere from 500 to 800,000, which they will use to justify rate cuts. But when you have U.S. stock valuations now at the most expensive in history, surpassing the dot-com and pre-Great Depression levels, you got some serious risks ahead if indeed they do this, as the public is all in on equities, all in on margin, all in highest ever, and all in on options exposure highest ever. That's a dangerous market as the insiders are moving this way, the other way. So I don't know. It's not too much happened that is off the charts this week. I'm sure there will be by next week, but just more continuation of the same.
Wanted to give you a chance to do a quick reading of the weekly specials.
AU grade 2.5 Indians, $120 over melt per coin. The 2.5 Indian is one of the only coins that you could actually attempt to buy the entire series of. There's 18 or so different dates. It is one that you could get every one, and it's an amazing coin, about the size of a dime. The MS62 $20 Liberty, $70 over melt. That's under spot because it's just under an ounce, but it's under 1 ounce gold price. In 2007 and 8, I would have paid you with $1,000 gold price. I would have paid you $1,650 for as many of these as you would sell me. Now you're getting them for under spot, 70 over melt. It's unheard of. 1 ounce gold PAMP Fortuna Veriscan bar at 99 over melt. Those are the really fancy ones that have the Veriscan. You hold your camera up to it and it'll bring you to a website. Those are really cool, and it proves the authenticity and the veracity of the bar. Brings you right to the webpage of PAMP. I love those. But again, when you're paying 99 over spot for that, or an MS62 Liberty, it's under spot, I wouldn't even think twice personally. I'd buy the $20 Liberties all day long. And lastly, the 10-ounce Royal Canadian Mint RCM bar at $2.49 over spot. I will go on record as saying they're the nicest 10-ounce bars you'll ever see. And they come in boxes of 500 ounces to a box. They're the class of the silver bar industry. So this is all really good stuff. To me, what really sticks out are the 62 $20 Liberties. I don't think you get many opportunities like this. In my career, I haven't seen this but for a brief second, like right now, in the last several months with all of this nonsense with low premiums. But to me, that's as good as it gets on the MS6220 Libs.
Well, we're grateful always for the weekly specials. Our viewers and subscribers do call and they ask for that list of specials. Folks, if you aren't on our free mailing list, you could get them for free if you were by just going to libertyandfinance.com, putting in your email address, submitting, and making sure you confirm on the confirming email. Then you'll get the specials every week. In addition to all of our interviews with Andy and all of our other guests, 1 email per day in your inbox. You won't miss anything. Otherwise, feel free to email us at libertyandfinance@protonmail.com. That's libertyandfinance@protonmail.com. Just pay specials. In the title of the email, we'll get you the latest list anytime you want it. No problem. And Andy, I'll give you the last word before we wrap on this weekly market update. I think you've got us caught up with a very eventful week with breaking out of both gold and silver, and actually the bond markets in the UK and Japan looking uglier than they have in a long time, and a lot of those forward indicators showing that there may be more ahead of what we've just seen in the last week or two. Anything else from you before we wrap?
I guess I would just simply say that everyone's been waiting for this moonshot, right? But it is moonshotting, just at its own pace. It keeps going higher. It goes up, it consolidates, it goes up, it consolidates. And that's the type of movement that is hard for people. The waiting is the hardest part. The little by little, then all at once. That all at once moment people are waiting for, but maybe it's little by little for a lot longer than people think until there's that all at once moment. But that all at once moment, you better be well positioned before it happens. We continue to see things moving in the direction that we've talked about, maybe just not at the speed or in the manner that we thought. But here we are, looking at $3,500 an ounce gold. Let me just look real quick here, and then I'll let you go. We got gold right now at $35.39. I mean, come on. And we have up $85. And we have silver at $41 right now, up $1.15. So, really? Are we not moving in the direction that we think? I hope people understand this is a train that's just getting going, because the public, any of you who own gold and silver, try talking to one of your friends for more than 5 minutes about any of this stuff and watch what happens. And yet, here we are, silver at $41 an ounce, and you won't see a word about it on the evening news tonight. Or gold at $3,539. Don't tell. You won't see it on the evening news. But it's outperforming everything. It's the tortoise. It's not the exciting hare. It's the tortoise, and it will continue to do this. So this is just the beginning. If I were going to make a guess, I wouldn't be surprised to see $4,000 gold by the end of the year. I wouldn't be surprised to see silver knocking on 50's door or more by the end of the year. Now, I normally don't say that, and I don't like saying those things, but if I were going to take a guess, those numbers are wickedly in play, very much so. I think maybe those are even undershooting where the potential could be, but that's not why we own it. But I think we're only 400, we're 15, not even 12, 13% away from $4,000. I think by the end of the year, that's highly probable.
Andy, we're always grateful for your presence here with us, and glad that we were able to put together this weekly market update again, and look forward to doing it again next week. And as always, thanks for joining us on Liberty and Finance.
You're the greatest, Don, again. Thanks for having me. I'm sincere about that. I love you guys. So look forward to seeing you next week. Until then, I'll look forward to it. Glad you're feeling better. Talk to you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for September 1st through September 8th, 2025, while supplies last. First this week, the pre-1933 gold AU grade US $2.50 Indian coin is just $120 over melt. Next, MS62 grade pre-1933 $20 gold Liberties are just $70 over melt per coin. 1 ounce gold Pamp Fortuna Veriscan bars are $99 over spot per ounce. And finally, 10 ounce silver Royal Canadian Mint bars, $2.49 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.